Good day, fellow investors. In this video, I want to give you my opinion, the summary on the latest Howard Marks memo saying that we are in a bubble. And also add this Bloomberg article commenting that can Howard Marks predict the next stock market bubble bursting twice, because he did that in 2000 just before the crash, and let's see if he can do that again. And then there was also this email from Marco saying how Howard Marks' memo aligns closely with the recurring themes in my videos about the S&P 500, the risk and reward. Plus, in the Bloomberg article, they mention Edward Macquarie's work. In other words, stocks aren't always a sure thing over the longer holding periods. Exactly the article that we discussed in this video 5 days ago. It might be that both Jonathan Levin here from Bloomberg and Howard Marks are watching our channel. Hi Jonathan, hi Marks. Thanks for subscribing. But let's immediately start with the summaries, the key topics, and the conclusion that, in my opinion, yes, we are in a bubble, and what that matters for investors. We're also going to change a little bit the S&P 500, because we are going to mostly use that in our value investment quadrant, because now the time horizon is 10 years, and that changes perhaps the risk and reward of investing. Let's start immediately. The top 10 US companies make 38% of the S&P 500, 67% of global market capitalization is the US, and that is very high compared to historical metrics. This is how Howard Marks starts his memo. If we look at the global market capitalization, 67%. The rest of the world is practically irrelevant, and everything is going into the US stock market bubble. A nice addition from Howard Marks when it comes to bubbles, we'll discuss valuations, debt levels, is just psychology. Irrational exuberance, adoration of the businesses, comments on Nvidia, Bitcoin, Tesla, nothing can destroy those businesses. Also Apple, Facebook, whatever, adoration does. Fear of missing out, and there is no price too high to pay because, as we discussed in videos, stocks only go up, right? And when it comes to no price too high, one of my best friends is a Bitcoin, I think, deca-millionaire. And he told me, Sven, buy Bitcoin when it was 4,000, now it is what, 100,000. He really made a lot of money with Bitcoin. The key is also, here Howard Marks mentions it above, there is nothing so disturbing to one's well-being and judgment as to see a friend get rich. Of course, I'm happy for my friend, but many others see all these people get rich, fear of missing out, then they go in, push stock price higher and higher and higher, and as long as that momentum lasts, stocks only go higher. By the way, on the Bitcoin friend, he's a genius, he's watching supply, demand, trends, this and that, so it's completely different ballgame than 99.9% of others. When it comes to that fear of missing out, just look at stock holdings. 30% of US households had them in 1989. We are close to 60 now. Of course, also directly held stocks, 20%, 2000s. Then it were some bad years, nothing sexy was happening, housing market was good, and the crash, just 13%. And now, if we look forward, we are again to the 21-22% of households holding stocks. And that is also something that Marx discusses, mentioning reflexivity with Soros, and that is a theory that positive feedback loops between expectations and economic fundamentals can cause price trends that substantially and persistently deviate from equilibrium prices. That is certainly something that is going on. The higher prices improve the fundamentals, everyone is attracted, more US, more business for those businesses. And we discussed also this in the inelastic market hypothesis, which is a key video if you want to understand how this market works. The problem with reflexivity, the opposite also works. The problem with the inelastic market hypothesis, buying pushes stock prices higher, 1 versus 5, but the reverse also is applicable. Savings, nobody's saving anymore. Retirement accounts have been stable, And bonds also, everyone is going into stocks, so this is clearly something to look at. Further, three stages of a bull market. The beginning, 2013, 2010, nobody was buying stocks, so only a few of us were buying. I was buying heavily with everything I had, 2009, 10, 11, 12. Then things are improving, improvement is taking place, more and more people, and then when things are so good, then everyone concludes that things can only get better forever. Everyone is getting rich, stocks must be great, but Howard Marks clearly discusses JPM, how he knew there was trouble ahead when the shoeshine boy gave him stock tips. Then we had housing. In the movie The Big Short, strippers bought houses, and then also the dot-com bubble where everyone was getting rich on tech stocks. That didn't last long. So there is always this new shiny thing, and Howard Marks goes to his experience, Nifty 50. But let's just go to my experience since I started this YouTube channel 7 years ago. So we've had weed stocks. Do you remember weed stocks? Well, boom, bust. Okay, the bubble lasted for first 2 years, then another boom, and then now nobody talks about these stocks. Then we had blockchain. Everyone was discussing blockchain. The Leaf tea company changed the name into the blockchain company. The stock jumped 3x, then they delisted because of fraud. Then we had the electric car boom. Remember NEO, ARK Innovation ETF, and I all made videos about this. Looked like an idiot when wheat stocks went up for 6 months. I made a video about NEO. I made a video about ARK at peak ARK situations. We discussed also, not to forget, beyond food. You must be beyond sanity to buy BYND. The result is there. And now I'm talking about the S&P 500, how stocks do not really return 10% all the time, sometimes well, but more likely 4% over the next 20-30 years. And then value investing is the way to invest forward. And this is a nice comment from Howard Marks. When a whole market or a group of securities is blasting off and a specious idea is making its adherents rich, few people will risk calling it out. And I was very surprised when the Dean of Valuation said that yes, the markets are richly priced, but not in a bubble. You should just average, keep on buying. So think about your last dollar. You're either in or out. There is no this and that. So everyone is very careful. Stocks for the long run shows how returns will be very bad. People discuss the cost of not being in the market. But what's the cost of being in the market is perhaps even more important, because at current valuations, historically, returns have been zero, and Wall Street keeps on forecasting 7,000, 10, 15% for stocks to go forward. Goldman said 0% for the next 10 years, but okay, maybe stocks can go up a little bit more. Then for concluding, for strategy, Howard says, it's not what you buy, it's what you pay that counts. Good investing doesn't come from buying good things, but from buying things well. There is no asset so good that it can become overpriced and thus dangerous, and there are a few assets so bad that they can't get cheap enough to be a bargain. Further, he continues with something that we do often also. Compare the top 20 with the top 20 now. 2000, we have 6 companies remaining, and only Microsoft was in the top 20 from the current Magnificent 7. This tells us a lot, because we don't know whether in the next 20 years of the Magnificent 7 there will be one that is now in the top 20. Businesses change, things change. It's extremely hard to predict for 1 year, let alone a decade or 2. And that is always the infatuation. People predict longer term, pushing valuations higher and higher because of the unlimited future profits, which is what creates a bubble. So to conclude, yes, to be a bubble, things have to burst, but let's call it, I think it is a bubble. I'm not investing in US high-priced stocks, There are some cheap stocks, but okay. Let's compare the bear versus bull thesis. We have been optimism 60% up since the last 2 years. That leads to extremely high valuations. Top 10 things change over time. Reflexivity works on the upside but also on the downside, which makes things very risky, and most likely returns will be negative for the next decade or two. The bulls say the P ratio is high but not insane, because those are all incredible businesses. Nobody's saying there is no price too high. They are just paying frothy, not bubble, and you missed on huge gains but not being investing. Don't make the same mistake. I'm calling it, this will not end well. We are with all factors of a bubble, and even Howard Marks says you can think for yourself. My thinking is, this is a bubble. Most likely it will not end well. I might look like an idiot for another year, 2 years, 3 years, 5 years. Same to me, I'll keep doing my thing that works no matter what. And then if we look at the S&P 500 over the past 5 years, everyone is mentioning this. If you count over more cycles, okay, the S&P 500 did 12% per year over the past 5 years. Now, what I want to discuss here, can we do 12% with less risk? Even if stocks go forward 10% a year for the next 5 years, can we do the same with much less risk? Or if you want a better portfolio, if you buy treasuries, are you happy with 4% with absolutely no risk? Warren Buffett is in US treasuries, 4 or 5%, no risk for 5 years, and you get to your financial goals. That is the key thing you must think about. Because if I look at the S&P 500, if I look at valuations, P ratio 30, as Warren Buffett says, when investors forget that corporate profits grow about 7% per year, they tend to get in trouble. And if I look at S&P 500 earnings, 171 to 196, that's not 10%, that's not even 5%. This is adjusted for inflation, just for reference. So when it comes to the S&P 500, if I have to put a 10-year horizon, returns 0 at best, thus very low reward, very high risk, and I'm putting it here. Slowly over time we'll start adjusting going forward. Value investing is fine. Same returns with no or low risk. Here you have 3 months US Treasury, 4%, no risk. Berkshire, 10-year, they will do their 5, 6, 7%, no risk. Then we have other companies depending on how you're liking, and I think I'm even better with my research platform because you can find value globally. So it is all up to you. I think it is a bubble. I invest in a way that even if it is or it isn't, I'm not affected. I do my thing and I try to separate myself from the market. Whatever happens, I'm happy you're all getting rich. Keep in mind, when you make money on valuation, you also have to sell to lock in that gains, which is something that few discuss. We can discuss it in another video if you wish. So that's it. Check what I do, check the other videos. I'll see you in the next one.